oil still moves higher?
Yeah, because, I mean, take China as an example. There's this, and I've pointed this out a couple of times in different things I've been doing, but there's this strange anomaly that's happening right now in China where car sales are actually, doing very well. We've seen some of the latest numbers in Shanghai and elsewhere, but at the same time, oil consumption is actually, not responding, at least not responding in a sort of linear or highly correlated fashion with the increase in auto sales. So the question you ask yourself is are people just buying cars to sort of keep as museum pieces because it's clear from the data that they're not driving them? Or at least not driving them as much as you would expect. And of course, what's happening is this is a function of the stimulus in China, and so you're seeing a lot of it going into capital assets. And I think what's going to happen in 2010 is you're going to see a lot of these capital assets get put into use, which even if the amount of stimulus declines, picking on China in particular, you're still going to see consumption trend higher than you would expect given economic growth.
I like that. That's probably one of the best answers I've heard on where oil is going in a while, actually. I read on your blog, you had a really great post on your blog recently about tail risk, which I understood to mean potential fringe risk scenarios that aren't so fringe. Give me a couple of the ones that you are, I don't want to say concerned about, but the ones that you definitely want to watch most carefully, a couple of your favorite tail risks, let's call it.
Sure. So, as you say, I sort of went through a fairly extensive list of some of the things that people need to be most concerned about, and we've touched on a bunch of them right now. The renewed super spike in oil, the sort of sovereign crisis around the dollar, with respect to this transition that the U.S. financing structure is going from being relatively skewed long term to relatively skewed shorter term in terms of the total liabilities of the debt structure of the United States right now. So these are all sort of potential tail risks that I worry about. But there's lots more. I mean, you can obviously, I think you need to be concerned about the sort of heads up we've gotten from H1N1 over the last year. That's not because specifically H1N1 is going to turn into something dire and catastrophic, but it showed how ill prepared we are for responding to any kind of a natural or even artificial biowarfare type introduction of a biologic into the global economies. We've completely fumbled this. I mean, despite having 12 months, 6 to 12 months
right.
of preparatory time. Look at what's happened in Canada. Look what's happened in the U.S. If this had actually been a serious situation, it would have been catastrophic. And yet, this was with ample warning and without hordes of people, dying all around the planet. And so, these are some of the examples of tail risks that I worry about. The other one that I worry about a great deal and talk about a lot. We saw an early example of it just this past week was in the Dubai scenario.
Right.
Is sovereign risk, and there are a host of sovereigns. Dubai is frankly, a flea on an elephant's ass from the standpoint of the consequences for the global financial system. It's a nice story and a great comeuppance, but there are many others, countries that are in, equally or even more problematic positions, not least of which, and I'm sad to say, is Greece, as the present company obviously included. But so is Ukraine, Latvia, Russia in some ways. There's a long list of countries that if we get to the point where there is the global pot for funding so much of what's happening at the sovereign level among the developed countries begins to feel squeezed, the people who will be squeezed out first won't be the U.S., it won't be Japan. It's going to be the people at the other end of the funding pipe who are never exactly the sorts of highly liquid and secure recipients of capital that people actually wanted to, felt comfortable about during the crisis in the first place, and they will all be en masse and in synchronous form, starved of capital, and we'll see serial defaults across Eastern Europe and at the worst possible time. And so these are all the sorts of tail risks that I think investors need to watch very closely. And in Dubai, while it got played that way, really wasn't that kind. It was a very different thing that was going on there, a very conscious decision on the part of the rulers. And what we need to watch for instead are this sort of serial cascading defaults that are likely to happen or could potentially happen in, let's say Spain, Germany, Latvia, Ukraine, and even potentially Russia, in a truly worst-case scenario. But these are all examples of tail risks.
Did it surprise you that there was such fast movement to the U.S. dollar? Gold dropped $60. It was almost all instantaneous. Did that surprise you, or did it at least give you comfort in the fact that, maybe the U.S. dollar still is really still has that currency of last resort strength and maybe hasn't lost its luster? It's easy to beat up for a long time, but as soon as the first sign of potential problem came, everyone rushed to the U.S. dollar. How should we interpret that?
So I see that very much as a function of liquidity, that crisis breeds an incredible lust for liquidity, and liquidity is this kind of mysterious thing that sort of runs in pools and pockets and hides in closets. But one of the best places, and probably the foremost place to find it in the world, is in treasury markets and the dollar. So as perverse as it seemed to many people, and I know many of my my compatriots were just floored by what happened, we shouldn't be surprised that this flight to safety is not so much a flight to the dollar as a flight to liquidity. And so until there is something with a market with comparable depth and liquidity, in a crisis you are always going to see people flee to the most liquid instruments because they want security. And right now that's the dollar, so it shouldn't have been altogether surprising.
I'm going to ask you one last question, kind of my maybe fringe or tail risk, if you want to call it that. Has the fiat paper money system failed? Any chance that we're going back to gold as tying ourselves to the gold standard?
So I think it's a great question, and it's something I puzzle over all the time. People who are advocates for the returning to a gold-backed system, in many ways, I think haven't thought through their history. At least if they paid attention to some of the limitations that system had, we'd have a more nuanced discussion. That's not to say that going back isn't a bad idea. It's just they both have some fairly important limitations, fiat-based and gold-backed. But my point now is I think I don't see how, at least in some countries, at least for some period of time, we're not going to see a system where we go back to being at least partially backed by gold. And we're seeing a little bit of that now with some sovereigns, the Indian example most recently, and we're seeing other rumblings about others buying chunks of IMF gold. Other countries trying to do the same thing, and at least create a tacit, if not an explicit, link back to gold, so that it looks like the ratio of the money supply to value of gold held in reserve looks more tenable, because there is a natural suspicion that, having seen how people respond to a financial crisis by turning on the printing presses and letting them howl, that it really drove home not just how fragile, but in many ways how valueless fiat paper currency systems can be when you need them most.
Yeah, and that is the big question that's been going through my mind as well. How long can the U.S. keep printing and using the printing presses? And you're right, you brought up good points how the world needs the U.S. at a certain point, but where does that tipping point come, or where does that
Well, right, and that's been the whole debate about, there's some wonderful books and articles out there. Reinhardt and Rogoff, This Time It's Different, is one I highly recommend to people, which looks at this question of, over the last 300 years of pre-modern and modern financial markets, what have been the tipping points in terms of countries that have built up massive amounts of debt and have approached the kinds of levels we're talking about now, and then undergone some kind of financial crisis. And there's lots of things we can point to, but unfortunately, this isn't physics, so there's no linear relationship and there's no mathematical predictive value. We know at some level it's too high, and at some level you get away with it for longer than you think. And the trouble for the U.S. market is that the U.S. dollar is that, as the reserve currency with this sort of last vestige of liquidity problem, or I suppose advantage to many investors, my worry is that we will, because it doesn't happen at 100% of GDP or 200% of GDP or 300% of GDP, we'll think that somehow the U.S. is different. And all that means is that when the end comes and the thing breaks, the break will be that much more catastrophic and awful. So, we should never convince ourselves that just because there's something unique that's allowed this thing that can't go on to go on longer than we think, that means it can go on forever, because it won't.
Well, and on that note, I'm going to encourage everyone who's listening in, if you don't do so already, to get yourself over to Paul's blog, because I'm hoping, Paul, that when that tipping point does come, you'll be able to identify it maybe just a little bit faster than the rest of us, and maybe give us a heads up on your blog at some point. Your blog address, I've got a bookmark, paul.kedrosky.com. I've got a bookmark, so I don't even remember.
Yeah, it's just Kedrosky.com. That takes you to the place.
Yeah, and there's a link to Paul's blog from this presentation. Paul, I could go on for another half hour, because this time has flown right by. So first of all, I want to thank you for taking time out of your day. Obviously, from reading your accomplishments and the things you do, you've got a busier schedule than anybody. So on behalf of everyone at AGORACOM, deep appreciation. Much thanks for taking time to talk to everybody. I'm going to leave the last word to you. Anything that we haven't covered, or anything that or the last takeaway point that you want to emphasize for people out there?
The only thing I would suggest to people is that, and this is sort of one of my rules of the road as I look at what's happening out there, is there's this kind of I call it naive contrarianism. So people will say, everyone loves gold, so I need to be short gold. Everyone's bullish on or bearish on the U.S., so I should be bullish on the U.S. And that kind of naive contrarianism is very easy, very obvious, and very dangerous, in particular at sort of giant inflection points like right now. So I would encourage people to always be watching for, because it's the way I think about the world, sort of appropriate contrarianism, that's great to run against the herd, but then this naive contrarianism where long before things have played themselves out, people are going to try and talk you into reversing your positions, and you shouldn't.
You've been listening to Paul Kedrosky at the AGORACOM Online Gold and Commodities Conference. Paul, thank you again for joining us. Everyone, you'll see the links to Paul's blog and other information, his Twitter account right here on the slide that hosts this presentation. Thanks to everyone for joining us. Hope you enjoyed it, and we're looking forward to your feedback on the blog.
Thanks, George.